Welcome to the latest episode of Quest for Twice. In the last episode, I made an investment case for Worker and Daimler. And last week, the WND stock increased by about 10%. So here, I want to provide a quick update. So the reason for the stock price increase was because of the announcement of WND to acquire Align Capital. And why it's considered a good news for WND? That's because of multiple avenues to increase the revenue for WND. So Align Capital is an integrated player in the affordable housing segment. With the combination, WND will have a very strong position in the affordable housing, and that's one of the growth targets WND set for 2025. So that's a good progress towards WND's growth strategy. And also because of Align Capital currently use various financing and sales agencies and services. Now with Align Capital in-house, then WND will be able to capture the debt financing and the property sales opportunities from Align's portfolio. That's a clear revenue synergy. Besides, Align Capital has over $10 billion of asset under management for investors. And with that brought into portfolio for WND, its combined AUM will be about $16 billion, and that also exceeded WND's 2025 target. Lastly, WND has been investing in technologies to make its operation more efficient, as well as increase opportunities to find additional source of revenue. So Align will be able to benefit from that technology investment made by WND. So that's clearly a synergistic acquisition for WND. Another thing that's good about this acquisition is that it's fairly sizable, and Aligned Capital is about 13% of WND enterprise value before the acquisition. So that will make a noticeable impact on the WND's revenue as well as the bottom line. And how much is WND going to pay for Align Capital? So it's actually at a fairly reasonable price that's measured by the ratio of enterprise value over EBITDA. That's about 11.6 without counting the synergy I just mentioned. So that's a fairly reasonable price with clear synergistic opportunities. So that's why I believe the market likes the announcement and rewarded the stock price last week. I'm going to switch gear and talk about a new company that I plan to invest in. That is a Boston Beer Company, ticker SAM. It's a fairly known company because of its main product, Samuel Adams. It's a craft high-end beer with in the top 3 position in the country. It also makes other products, including hard lemonade, hard iced tea, and hard seltzer. Seltzer is bubbly water. So this graph shows Boston Beer's revenue from 2012 to this year. The revenue in 2021 is the projected value based on the company's latest guidance. So we can see that its revenue increased from 2012 to 2015, then had a dip in 2016 and 17 before grow again. And it experienced explosive growth in 2019, 2020, and 2021. The main reason of that rapid growth was because of its a very successful launch of a truly hard seltzer, especially during pandemic last year. A lot of people bought a lot of hard seltzer, and I guess with the bars and restaurants shut down, they just consume that in their houses. An interesting metric to note is the gross margin. So before 2018, its gross margin was fairly steady at about 52%. Then, with the recent growth, its margin declined from over 50% to about 46% projected for 2021. The main reason behind that is because of with the explosive growth, Boston Beer did not have sufficient in-house production capacity, so it had to contract third parties to produce the hard seltzer, and of course, using third-party facilities will incur higher cost. So if we fit an exponential trend line to the revenue, its growth was about 11.8% annually in the last 10 years, and with the recent growth much faster than that. This graph shows the revenue for the last 10 years against the marketing and the sales expense in those corresponding years. And this time, just because of the limitation of Excel, 2021 is plotted on the left, and 2012 is plotted on the right. So we can see that the steady revenue increase from 2012 to 2021. In company with that, its marketing and sales expense also increased significantly in the last 10 years. So why is it interesting? Because we have to ponder this question. Is marketing an expense or investment? In accounting, it's treated as an expense. However, I believe it is an investment for future growth. And put it this way, if Boston Beer stopped spending on marketing, probably for this year, its sales will still reach its projection. With the with the insignificant impact on its sales. However, with the reduced marketing and selling expense in this year, its future revenue will likely suffer. That's why I believe it's an investment for future growth. So from that length, the increased expenditure for marketing and sales is actually a good thing, because that means it's investing for its future growth. Anytime when we talk about the investment for the future, we need to ask, was it a wise investment? So that can be judged based on the return on invested capital. And here I calculate that before tax. So its lowest return on invested capital, including the marketing and the selling expenses, were 13% in 2016 and 17. So that's the low water mark. And in 2018 and 19, it was between 16 and 18%. And in all the other years, the return was over 20%. So my conclusion is Boston Beer had a strong track record of wise investment, which drove revenue and profit growth, and that explained the revenue growth in the last 10 years. Based on the revenue picture, one would think Boston Beer is having great success in its business. Now let's take a look at its stock price in the last 5 years. So at the end of 2020, its stock price was about $400 for each share, and then it increased to over $1,300 at the beginning of 2021. Recently, it plummeted to less than $600. So that's about a 50% reduction in the span of 7 months. The large increase in 2020 was because of the strong revenue growth that's driven by the truly hard seltzer sales during the pandemic. And the recent plummet was because the slowdown in the hard seltzer segment. On September the 8th, the management withdrew full-year financial guidance, including shipment guidance. Previously, on July 22nd, the management revised the growth guidance to 25 to 40% instead of the guidance of 40 to 50% given in April. That's due to the surprisingly fast deceleration of hard seltzer growth in 2021. That's likely due to the reopening and shifting alcohol consumption from at home to outside homes, including bars and restaurants. And also, there have been a lot more new entrants into the hard seltzer segment because of its past success attracted new companies to make hard seltzer, and that increased the competition on this segment sales. So at the current stock price, is it a good value? To answer this question, let's take a look at the EBITDA in the last 10 years. So we can see that its EBITDA increased steadily from 2012, then with a slowdown from 2016 to 2018, then had an explosive growth in the last 3 years, including 2021, the projected EBITDA. So the compounded annual growth rate of EBITDA is about 9% if we use the 10 years data. We need to keep in mind that the EBITDA understates the cash generation because of the large marketing and selling expenses. Even with those expenses excluded from EBITDA, we can still use EV over EBITDA as a useful valuation metric. So at the end of 2020, EV over EBITDA ratio was about 42. So the investors were expecting really strong growth far into the future because 42 is considered very, very high, and that's on par with the almost best growth companies. Now, with the recent stock price reduction, as well as using the 2021 projected EBITDA, now the ratio stands at about 17.6, and that's in line with a slow growth company. So if Boston Beer can grow its EBITDA by about 9% in the next 2 years, and the enterprise value goes nowhere, then the ratio will decline to about 15. So I would conclude that at the current price, the company just need to have a modest growth to justify the current valuation level. So let me summarize the investment thesis and the risks. Boston Beer is a high growth company that is reasonably valued. We need to consider that the hard seltzer is now going away. With the pandemic, the alcohol consumption went up, especially at home. So once people get used to it, they will likely keep drinking it. So it's not going to be a abrupt reversal of that. It's true that the hard seltzer sales is decelerating, but the deceleration is not the same as a decline. Even at the low end, 25% shipment growth is still very high growth. And if future sales can grow 5% annually, then the current valuation level is justified. In other words, the downside is limited. If Boston Beer can grow its sales in the double digit or even the low double digit, then there will be a lot of upside to its sales and profitability. So what are the threats and opportunities to this investment thesis? So in near term, the gross margin and the EBITDA margin will improve because Boston Beer has been investing in building its own facilities. Once they come online, then the cost will come down. Even with the same amount of sales, the gross profit and EBITDA will improve. In the midterm, as I mentioned earlier, Boston Beer has been investing in marketing and sales to increase its brand asset. And that brand asset will grow from more marketing expenditures. And if we believe it's a track record of wise investment in marketing and sales, then the increased brand asset will drive sales higher. So those are the opportunities for near term and midterm. For the long term, I do see some threats. The key one is that when will the hard seltzer market share stop growing? To me, its taste is not as flavorful as beer, and it'll be hard to differentiate from its competitors. Of course, with better marketing, it may still capture large market share. However, there are some threats to its market position. Another threat is the management credibility. The recent stock price plummeted partially because of loss of confidence in management because they really came out of nowhere about a month ago and just drastically reduced their projection for the 2021 sales. So the analysts and the investors' confidence was shaken. Another example was that I reviewed the annual report in 2016 and 2017. And they do not provide a really sufficient explanation on why sales in those 2 years slowed down compared to the prior years. And also, they do not provide sufficient information to understand the underlying business. For example, how much sales was from hard seltzer and how much sales was from Samuel Adams and how much was from the IPA beer. So I do see that as an obstacle to clearly understand the underlying business and to have confidence in the long-term sales growth potential of the Boston Beer. Put together, I believe that this company presents a good opportunity in terms of a favorable benefit versus a downside risk in the short term and the mid-term. In the long term, it's hard to say. We'll just have to go along with the ride and see how the sales materialize in the future. So I plan to build a small position in Boston Beer. I enjoy researching and learning this new company. Until next time, happy investing.